Video. Now today we are going to speak about the dollar index, and I'll give you guys an analytical breakdown of what we can potentially expect from the US CPI, what it means, how you can trade it, and how you can make use of it depending on either outcome. Now, if you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoyed the video, please smash the like button for the YouTube algorithm. And as always, let me know down in the comments below exactly what it is that you'd like me to cover in my next video. Yesterday, I had a gentleman that asked me on YouTube, when do I think the dollar is going to fall? Well, I would like to thank you for thinking that I have that information at hand. Unfortunately, I don't have that information available. However, what I do is I do market research to go and look at data that could potentially cause the dollar index to pull back, not collapse, but to pull back. And I've made a video on the US recession I think it was last week, so you can just refer back to that video and it will give you further detailed information there as well. And that's why I also encourage you guys, make sure that you watch the videos from the beginning through the end, because there is a lot of valuable information through there as well. Now, without any further ado, let's jump straight into it, ladies and gentlemen. Now, firstly, for those of you that don't know, the CPI is basically the consumer price index. It measures monthly changes in prices for a range of consumer products, and changes in CPI record the rate of inflation. And CPI can also be used as a cost of living, and inflation just means when prices of goods and services increase, which is bad for consumers. Now we're gonna start over here. Now we can see here April's consumer price index report expected to show inflation has already peaked. Now you probably saw this on my Instagram this morning, and it says here investors are eyeing what could be a pivotal consumer price index report for April, anticipating that data shows inflation has already reached its heights. Economists warn that prices could remain elevated. The issue is how fast inflation could decline when it comes to determining how the Federal Reserve will respond with interest rate hikes. CPI is expected to rise at 0.2% in April, or 8.1% on an annual basis. That's compared with a 1.2% monthly increase, or a 8.5% gain year over year in March. Now, Powell has been talking a lot about how they're going to bring inflation down. Media is posting what you can expect from inflation, and this one's saying this and the next one's saying that. And not to bombard you with too much information so that you don't get confused, I'm going to put this for you in layman's terms. Now the simple question is a higher CPI good for the dollar? Now, signs of inflation, as you guys know it, signs of inflation just means that the central bank has to raise the interest rates. And if you've been here for a while, you know that interest rates means good for the dollar index and bad for the stock market. The most widely used indicator to know whether or not the banks are going to increase interest rates is the CPI. Now, if the CPI increases, then it gives the central bank, such as the Federal Reserve, the necessary supportive data to hike interest rates. And we know that higher interest rates is bullish for any economy. Now, hope you wrote that down, because that was a mouthful there as well. Now, it's important to dive even further deeper than that, right? Now, before we get there, it's quite clear that the dollar index has not been moving. And if you ask me, what do I mean? If you look here, today is Wednesday. So if you come back Wednesday, you go Tuesday, Monday. This is where the week had opened, right? And the dollar index had been trading sideways since Monday over there, right? It had not been moving. And this is normally what the market does. If you go look at last week, if you go look at last week before the interest rate decision, which is what we saw here, the market was, as the market was moving sideways, and then we had that liquidity grab and the market came back. Market then, and this is how they grab the liquidity required to make the next move. Now, the first question is, why does CPI even matter? Well, we know that if you're on the USA, well, Americans undoubtedly consume petrol and food. These items prices are volatile, and the Federal Reserve cannot control them at all. Now, these are mostly on the supply side, right? Now, the supply side issues are driven by global forces, such as what's going on with Russia and Ukraine. I don't even know what's going on there anymore. OPEC plus petrol output, and the dollar moves to the tune of the federal interest rates all the time. If the feds play this song, then the dollar says, let's go. If the Fed says, let's go this way, then the dollar says we're going that way. So wherever the Federal Reserve goes, that's where we go. And the Federal Reserve says high CPI, hike interest rates, bullish dollar, then the stock market go high CPI, hike interest rates, weaker stock market. That's it. That's how easy it is to read this. Now, what can the Fed, well, the question is what the Fed can significantly impact is demand. Okay, that is what the Fed can impact. Now, the Fed doesn't have that much control over the CPI because it's driven by global forces such as Russia, war, and Ukraine, as well as OPEC. OPEC moves petrol prices here like it's nobody's business, and people in South Africa is complaining that petrol prices are too high. Now, you should have known that a long time ago. Now, but what the Federal Reserve can do to tackle CPI, the inflation, is impact demand. So if they raise or if they hike interest rates, consumers are motivated to save money rather than to take out loans to make big purchases. It has vowed to bring inflation down with higher borrowing costs, and it can afford to do so. Also, the latest jobs report, which is the NFP, shows a tight labor market. Like Powell always say, employment has room to climb down from the highs as well. Now, that tells us already that there could be some bad negative data also. Well, that should be able to tell you that as well, depending on the CPI data that we are going to get here once again, ladies and gentlemen. Okay, now let's move along, right? Let's continue with our conversation. Okay, so like I was saying, okay, so this is where we are at now. Okay, the previous was 0.3%, the forecast is 0.4%, right? So there is two scenarios, right? There is two ways that this can play out. It is expected to be at 0.4%. Now, if the CPI comes out at 0.4, now I need you to listen to me properly. If the CPI comes out at 0.4% as expected, okay, this is most likely what we can expect. This is going to be the positive one for the dollar. The 0.4 estimate comes after we had a lot of economists missed last month's figure by 0.2%, because last month they said it was going to be 0.2%, but it came out to 0.3%. So investors are not, like, they're not scared this time around there as well. Now, on an annual basis, it would reflect a raise of almost 5%, substantially above the Fed's 2% line target. It would also suggest a higher than 0.3% level recorded in March, and would label that figure as one of slowdown in price raises. In other words, peak inflation would remain a mystery also. Now, the next one is that, right? So if the data comes out lower than a 0.3%, then it's done for the dollar index. Okay, then there is no dollar index. Then the dollar index is definitely going to pull back, and we can see that the stock market slowly recovering on that as well. So if America records 2 consecutive months of a 0.3% underlying inflation rises, it would strengthen the Fed's conviction of raising interest rates by only half a basis point in June, lowering the chances of a bigger 75 basis point hike that will send the dollar to the floor, right? Hope you guys are still here. Now, here's the worst thing that can happen, right? The worst thing that can happen is if this numbers come out at 0.5%, this figure will be crazy. Now that means the Fed will probably have to raise the interest rates by 1%. Now, it's very important to keep in mind, ladies and gentlemen, that the Fed is focused on inflation, not employment, and every tick in the underlying prices would have an outsized impact on the markets. The base case scenarios of ongoing high inflation and ongoing hawkish approach by the world's most powerful central bank and a driver of further dollar gains there, my friend, as well. So there you have it. That was as easy as possible. 0.3%, then the dollar is going to not recover, but it's gonna have to pull back. A 4%, then there. Jesus, a 5%, then we're going there. Okay, now what does that mean for the stock market? A 0.3%, that's fine. A 0.2%, Jesus, a 0. No, I'm just saying I'll never go to 0.1%, but those are the numbers, and if those numbers come out, then think about it the opposite way of. So this is what you can expect. The 0.3% would be the dollar index falling and the stock market growing. Anything other than that is going to be the opposite ways for both markets there. Sorry, as well. So this is basically where we are now, guys. So anything can happen from here, and all eyes on the CPI data. Now, it's important that you don't gamble when you do trade the fundamental data. I want to say thank you for your time. Thank you for taking the opportunity to watch the video. And as always, cheers for years.